Question 1. Which of the following best describes the key distinction between facultative reinsurance and treaty reinsurance? A facultative reinsurance is a type of proportional reinsurance, whereas treaty reinsurance is a type of non-proportional reinsurance. B. Facultative reinsurance is a reinsurance arrangement for a single risk, while treaty reinsurance involves a group of risks covered under a contract. C. Facultative reinsurance involves automatic coverage of all risks, whereas treaty reinsurance requires individual negotiation for risk. D. Facultative reinsurance is a form of retrocession, while treaty reinsurance is a direct reinsurance contract. Answer: B. Facultative reinsurance is a reinsurance arrangement for a single risk, while treaty reinsurance involves a group of risks covered under a contract. Explanation: facultative reinsurance is negotiated and applied to individual risks, allowing reinsurers to evaluate and accept or reject specific risks as they arise. This makes facultative reinsurance highly customizable. On the other hand, treaty reinsurance covers a portfolio of risks under one contract. The reinsurer agrees to accept all risks that fall under the terms of the treaty without evaluating each risk individually. The key difference is that facultative is individual and specific, while treaty covers multiple risks collectively. This distinction aligns with the principles of risk transfer in reinsurance. Question 2. Mr. Thompson, a reinsurance broker, is working with a ceding insurer and a reinsurer. He finds that the ceding insurer has underreported its premiums by a significant margin. What is Mr. Thompson's best course of action according to Nevada reinsurance regulations? A. Report the discrepancy to the reinsurer and allow them to pursue the ceding insurer directly. B. Ignore the discrepancy, as it is not Mr. Thompson's responsibility to audit the ceding insurer's premiums. C. Report the discrepancy to the Nevada Department of Insurance, as it violates the principle of full disclosure and transparency. D. Wait until the reinsurance contract renewal to address the issue and let the ceding insurer handle it. Answer: C. Report the discrepancy to the Nevada Department of Insurance, as it violates the principle of full disclosure and transparency. Explanation: under Nevada state law, all reinsurance brokers have an ethical responsibility to ensure that all terms and premiums are accurately reported and disclosed. The Nevada Department of Insurance mandates transparency in reinsurance transactions to maintain fairness and regulatory compliance. If a broker becomes aware of any discrepancies, they must report them to the relevant authorities. Ignoring such discrepancies or leaving them for the insurer to handle later would be considered a violation of both ethical and legal obligations. This ensures that the principle of fair dealing and full disclosure is upheld in all reinsurance transactions. Question 3. Which of the following factors has the most significant impact on the pricing of reinsurance premiums? A. The reinsurer's historical claim settlement rate. B. The general economic conditions and interest rates. C. The loss experience of the ceding insurer and its risk portfolio. D. The rating of the reinsurance broker handling the transaction. Answer: C. The loss experience of the ceding insurer and its risk portfolio. Explanation: the most critical factor in determining reinsurance premiums is the loss experience of the ceding insurer. The reinsurer assesses the past claims history, risk exposure, and overall portfolio of the ceding insurer to determine how much risk they will assume. Premiums are based on the expected losses, so a higher likelihood of claims or more significant lead to higher premiums, while factors such as economic conditions, B, and the reinsurer's claim settlement rate, A, can influence pricing. The ceding insurer's risk profile is the fundamental driver in reinsurance pricing models. The rating of the reinsurance broker, D, generally does not directly affect the premium price but could influence negotiations and terms. Question 4. Which of the following best explains the purpose of retrocession in the reinsurance industry? A. Retrocession is the transfer of risk from the ceding insurer to a reinsurer for higher premiums. B. Retrocession is when a reinsurer transfers a portion of the risk they have assumed to another reinsurer to manage risk exposure. C. Retrocession is a method for reinsurers to increase their underwriting capacity by assuming more risk from ceding insurers. D. Retrocession refers to a situation where reinsurers refuse to honor claims made by ceding insurers. Answer: B. Retrocession is when a reinsurer transfers a portion of the risk they have assumed to another reinsurer to manage risk exposure. Explanation: retrocession is the process by which a reinsurer transfers a portion of the risks they have assumed to another reinsurer, typically referred to as a retrocessionaire. This is done to manage the reinsurer's risk exposure and protect their financial stability, particularly when the risks are too large or concentrated. This concept is part of the broader risk management strategies used by reinsurers to spread their liabilities across multiple parties. Retrocession does not involve refusing claims D, and it is not directly tied to increasing underwriting capacity C, or simply transferring risk for higher premiums A. Question 5. Under Nevada reinsurance regulations, which of the following is required for a reinsurer to maintain a license to operate within the state? A. The reinsurer must provide a guarantee fund to cover any potential future claims. B. The reinsurer must submit audited financial statements and demonstrate sufficient solvency. C. The reinsurer must maintain a minimum level of reserves as determined by the ceding insurer. D. The reinsurer must enter into a contract with a local insurance broker for exclusive reinsurance agreements. Answer: B. The reinsurer must submit audited financial statements and demonstrate sufficient solvency. Explanation: to maintain a license to operate in Nevada, a reinsurer is required to submit audited financial statements to demonstrate their financial stability and solvency. This ensures that the reinsurer has sufficient financial resources to meet their obligations under reinsurance contracts and that they are capable of paying claims when they arise. Nevada's regulatory framework is designed to protect policyholders by ensuring that reinsurers maintain the financial strength necessary to fulfill their contractual duties. Options A, C, and D are not directly related to the state's regulatory licensing requirements for reinsurers. Question 6. Which of the following is a key consideration when pricing catastrophe reinsurance? A. The claims history of the reinsurer over the past 5 years. B. The financial stability of the ceding insurer. C. The probability of a catastrophic event occurring and the severity of potential losses. D. The total premiums received by the reinsurer in the previous year. Answer: C. The probability of a catastrophic event occurring and the severity of potential losses. Explanation: catastrophe reinsurance pricing is primarily based on the risk of a catastrophic event occurring, such as a natural disaster, and the potential severity of the losses associated with that event. Reinsurers assess the probability of such events based on historical data, risk models, and geographical factors. This information helps determine appropriate premium to charge in order to cover the potential large-scale losses that could result from a catastrophe. The claims history of the reinsurer. A. The financial stability of the ceding insurer. B. And premiums received in the prior year. D. Are important considerations in general reinsurance pricing, but are not the main factors in catastrophe reinsurance. Question 7. A reinsurer has entered into a proportional reinsurance contract with a ceding insurer, which is structured as a 50% quota share. If the ceding insurer collects $10 million in premiums, how much of the premium will the reinsurer receive under this contract? A. $5 million. B. $2.5 million. C. $10 million. D. $1 million. Answer: A. $5 million. Explanation: under a 50% quota share proportional reinsurance contract, the reinsurer is entitled to 50% of the premiums collected by the ceding insurer. Therefore, if the ceding insurer collects $10 million in premiums, the reinsurer would receive $5 million. The quota share agreement means that both the ceding insurer and reinsurer share the premiums and losses on a proportional bit, with the reinsurer receiving half of the premium in this case. Question 8. In Nevada, which of the following is true regarding the regulatory requirements for reinsurance contracts? A. Reinsurance contracts are required to be filed with the Nevada Department of Insurance for approval before they become effective. B. Reinsurance contracts must be in writing, but there is no need for state approval unless the reinsurer is foreign. C. Reinsurance contracts must specify the commissions payable to the ceding insurer, but no other terms are regulated. D. Reinsurance contracts are not subject to state regulations, as long as both parties agree to the terms. Answer: B. Reinsurance contracts must be in writing, but there is no need for state approval unless the reinsurer is foreign. Explanation: under Nevada regulations, reinsurance contracts are required to be in writing to ensure clarity and enforceability. However, these contracts do not require state approval unless the reinsurer is foreign. This is because Nevada's regulatory framework primarily oversees the solvency and financial reinsurers rather than approving individual contracts unless certain conditions are met, such as the involvement of foreign reinsurers or specific contract types. Option A is incorrect because state approval is not required unless the reinsurer is foreign. Option C is incorrect as well, as reinsurance contracts are subject to comprehensive regulation, not just commission disclosures. Question 9. Mr. Allen is a ceding insurer who has entered into an excessive loss reinsurance agreement with a reinsurer. The agreement covers losses above $1 million. If the claim occurs resulting in a total loss of $3 million, how much would the reinsurer cover under this agreement? A. $2 million. B. $3 million. C. $1 million. D. $0. Answer A. $2 million. Explanation. In an excessive loss reinsurance agreement, the reinsurer covers losses that exceed a specified threshold known as the attachment point. In this case, the reinsurer's coverage begins after the $1 million threshold is exceeded. Since the total loss is $3 million, the reinsurer would cover the amount above $1 million, which is $2 million. The ceding insurer would be responsible for the first $1 million of the loss, and the reinsurer would cover the remaining $2 million. This is a common feature of non-proportional reinsurance contracts. Question 10. Which of the following is true regarding the underwriting process in reinsurance? A. Reinsurers typically underwrite risks based solely on the historical loss experience of the ceding insurer. B. Reinsurers underwrite risks based on the ceding insurer's overall risk portfolio, including geographic, industry, and exposure considerations. C. Reinsurers are not involved in the underwriting process as they rely entirely on the ceding insurer's risk assessment. D. Reinsurers underwrite risks based on the premiums paid ceding insurer and not the actual risk exposure. Answer. B. Reinsurers underwrite risks based on the ceding insurer's overall risk portfolio, including geographic, industry, and exposure considerations. Explanation. Reinsurers do not solely rely on historical loss experience to underwrite risks. Instead, they take a comprehensive approach by evaluating the ceding insurer's entire portfolio of risks, including factors such as geographic location, industry exposure, and the nature of risks involved. This approach allows reinsurers to assess potential losses more accurately and price reinsurance premiums accordingly. Option A is too narrow, and option C is incorrect as reinsurers are actively involved in underwriting. Option D misrepresents the underwriting process, which is based on actual risk exposure, not just premiums paid. Question 11. Which of the following is the primary advantage of facultative reinsurance over treaty reinsurance? A. Facultative reinsurance is automatically applied to all risks of the ceding insurer. B. Facultative reinsurance allows the reinsurer to evaluate each individual risk before accepting it. C. Facultative reinsurance typically results in low premiums for the ceding insurer. D. Facultative reinsurance is less flexible in terms of risk selection. Answer. B. Facultative reinsurance allows the reinsurer to evaluate each individual risk before accepting it. Explanation. Facultative reinsurance provides the reinsurer with the opportunity to evaluate and underwrite each risk individually before agreeing to assume it. This allows for greater flexibility and more tailored risk management. In contrast, treaty reinsurance applies automatically to a broader category of risks and does not require individual evaluation. Option A is incorrect because facultative reinsurance is not automatic. Option C and D are incorrect as facultative reinsurance is more flexible and often results in higher premiums due to the individual risk assessment involved. Question 12. Mr. Foster, a ceding insurer, enters into a proportional reinsurance treaty with a 70% quota share. If the ceding insurer collects $5 million in premiums, how much will the reinsurer receive? A. $1.5 million. B. $3.5 million. C. $5 million. D. $3 million. Answer. B. $3.5 million. Explanation. Under a 70% quota share proportional reinsurance treaty, the reinsurer receives 70% of the premiums collected by the ceding insurer. Therefore, if the ceding insurer collects $5 million in premiums, the reinsurer will receive $3.5 million, 70% of $5 million. The reinsurer's share is directly proportional to the agreed upon share percentage. Question 13. Which of the following best describes the purpose of risk modeling in catastrophe reinsurance? A. Risk modeling predicts the specific date of a catastrophic event. B. Risk modeling helps estimate the potential financial impact of catastrophic events. C. Risk modeling eliminates the need for underwriting in catastrophe reinsurance. D. Risk modeling ensures that reinsurers will never face catastrophic losses. Answer: B. Risk modeling helps estimate the potential financial impact of catastrophic events. Explanation: risk modeling in catastrophe reinsurance is used to estimate the potential financial impact of catastrophic events, such as natural disasters, by analyzing historical data, geographical factors, and other variables. The goal is to assess the severity and likelihood of such events to price reinsurance coverage accordingly. Option A is incorrect because risk modeling does not predict the exact timing of a disaster. Option C is incorrect as underwriting is still essential. Option D is incorrect because no model can guarantee the avoidance of catastrophic losses. Question 14. What is the primary regulatory concern when reinsurers are assessing the solvency of a ceding insurer under Nevada's reinsurance laws? A. The ceding insurer's ability to pay premiums to the reinsurer. B. The ceding insurer's ability to meet its liabilities to policyholders and other creditors. C. The ceding insurer's market share in Nevada. D. The ceding insurer's use of surplus lines reinsurance. Answer: B. The ceding insurer's ability to meet its liabilities to policyholders and other creditors. Explanation: under Nevada law, the primary regulatory concern when reinsurers assess the solvency of ceding insurer is the ceding insurer's ability to meet its obligations to policyholders and other creditors. This ensures that the ceding insurer is financially sound enough to handle its liabilities. Option A is incorrect because solvency assessments are focused on broader liabilities, not just premiums. Option C is not directly relevant to solvency. Option D is related to regulatory considerations but not directly tied to solvency assessments. Question 15. In a reinsurance arrangement, what is the function of ceding commission? A. The commission is a percentage of the premiums paid to the reinsurer by the ceding insurer for administrative expenses. B. The commission represents the reinsurer's share of the underwriting profit in proportional reinsurance contract. C. The ceding commission is payment made by the reinsurer to the ceding insurer for assuming the risk. D. The commission is an additional premium paid by the ceding insurer to the reinsurer for claims handling. Answer: B. The commission represents the reinsurer's share of the underwriting profit in proportional reinsurance contract. Explanation: in proportional reinsurance arrangement, the ceding commission is payment made by the reinsurer to the ceding insurer, typically based on percentage of the premiums, and it represents the reinsurer's share of the underwriting profit. The ceding insurer may use this commission to cover acquisition costs or other expenses. Option A is incorrect because the commission is not meant for administrative expenses. Option C misrepresents the commission's purpose as it is not payment for assuming risk. Option D is incorrect because the commission is not related to claims handling. Question 16. Which of the following is the key difference between excessive loss reinsurance and proportional reinsurance? A. Excessive loss reinsurance covers a percentage of the ceding insurer's premiums, while proportional reinsurance covers all premiums. B. Excessive loss reinsurance is typically more expensive than proportional reinsurance because it covers higher losses. C. Excessive loss reinsurance covers losses above specified amount, while proportional reinsurance shares losses and premiums in set proportion. D. Excessive loss reinsurance involves risk sharing between the ceding insurer and reinsurer than proportional reinsurance. Answer: C. Excessive loss reinsurance covers losses above a specified amount, while proportional reinsurance shares losses and premiums in a set proportion. Explanation: the key difference between excessive loss reinsurance and proportional reinsurance is that excessive loss reinsurance covers losses above a specified threshold or attachment point, whereas proportional reinsurance involves sharing losses and premiums in a set proportion. Excessive reinsurance is typically used for catastrophic events, while proportional reinsurance spreads risks in a more uniform manner. Option A is incorrect because both types of reinsurance can cover premiums but differ in risk-sharing structures. Option B is incorrect as excessive loss reinsurance may not always be more expensive. Option D is incorrect because excessive loss reinsurance does not necessarily involve more risk-sharing. Question 17. Mr. Taylor is a reinsurer who is analyzing the financial health of a ceding insurer. Which of the following is a key factor Mr. Taylor should consider when assessing the ceding insurer's financial stability? A. The ceding insurer's total number of policies sold. B. The ceding insurer's reserve levels for future claims. C. The ceding insurer's commission structure with its agents. D. The ceding insurer's market share relative to its competitors. Answer: B. The ceding insurer's reserve levels for future claims. Explanation: when assessing the financial health of ceding reinsurer like Mr. Taylor should focus on the ceding insurer's reserve levels, as these reserves represent the funds set aside to pay future claims. Adequate reserves are a key indicator of an insurer's ability to meet its obligations. Option A is not as directly related to financial stability. Option C focuses on the commission structure, which is less critical for assessing overall financial health. Option D is important for market competitiveness, but not necessarily for evaluating financial stability. Question 18. Which of the following is the most important factor in pricing reinsurance premiums for non-proportional reinsurance contracts? A. The ceding insurer's loss ratio over the past 5 years. B. The underwriting profit of the ceding insurer. C. The frequency and severity of potential claims based on historical data. D. The ceding insurer's administrative expenses. Answer: C. The frequency and severity of potential claims based on historical data. Explanation: in non-proportional reinsurance, pricing premiums is primarily based on the frequency and severity of potential claims, as these factors determine the reinsurer's exposure to large losses. Historical data is used to predict the likelihood and magnitude of future claims. Option A is less relevant as it focuses on past losses rather than future risk. Option B is incorrect because underwriting profit does not directly influence premium pricing for non-proportional contracts. Option D is unrelated to pricing reinsurance premiums. Question 19. Which of the following best describes the attachment point in an excess of loss reinsurance contract? A. The amount of premiums paid by the ceding insurer to the reinsurer before the reinsurance coverage begins. B. The maximum amount the reinsurer will pay out under the reinsurance contract. C. The minimum amount of loss the ceding insurer must incur before the reinsurer assumes any liability. D. The amount of risk the reinsurer agrees to retain under the contract. Answer: C. The minimum amount of loss the ceding insurer must incur before the reinsurer assumes any liability. Explanation: the attachment point in an excess of loss reinsurance contract represents the minimum amount of loss the ceding insurer must incur before the reinsurer assumes liability for the loss. This threshold protects the reinsurer from small or frequent claims. Option A is incorrect as the attachment point is related to losses, not premiums. Option B describes the limit of liability, not the attachment point. Option D misrepresents the purpose of the attachment point, which focuses on the loss amount before the reinsurer's involvement. Question 20. Which of the following is an example of alternative risk transfer? A. Mechanisms in reinsurance. A. Excessive loss reinsurance. B. Quota share reinsurance. C. Insurance-linked securities ILS. D. Facultative reinsurance. Answer: C. Insurance-linked securities ILS. Explanation: insurance-linked securities ILS are a form of alternative risk transfer that allows insurers and reinsurers to transfer risk to the capital markets through instruments such as catastrophe bonds. These mechanisms offer flexibility and enable risk transfer beyond traditional reinsurance contracts. Option A, B, and D all refer to traditional forms of reinsurance, not ART mechanisms. Question 21. In a reinsurance treaty, what is the primary purpose of retrocession aid? Is a form of insurance where the ceding insurer purchases coverage for their own reinsurance liabilities. B. It is a transaction where a reinsurer passes on part of its risk to another reinsurer. C. It refers to the reinsurance premium paid by the ceding insurer to the reinsurer. D. It is the process of collecting and distributing between insurers and reinsurers. Answer: B. It is a transaction where a reinsurer passes on part of its risk to another reinsurer. Explanation: retrocession occurs when a reinsurer transfers part of its assumed risk to another reinsurer. This allows the reinsurer to spread risk and reduce its exposure. Option A describes reinsurance, not retrocession. Option C is incorrect because it confuses retrocession with premium payments. Option D is not relevant to the specific meaning of retrocession. Question 22. Which of the following is the key feature of proportional reinsurance? A. The reinsurer covers only catastrophic losses. B. The reinsurer and ceding insurer share premiums and losses in an agreed-upon percentage. C. The reinsurer assumes all losses above a specified threshold. D. The reinsurer pays a fixed amount regardless of the losses incurred by the ceding insurer. Answer B. The reinsurer and ceding insurer share premiums and losses in an agreed upon percentage. Explanation. Proportional reinsurance involves a sharing of premiums and losses between the ceding insurer and the reinsurer according to a specified percentage, such as in quota share or surplus share arrangements. Option A describes excessive loss reinsurance. Option C refers to non-proportional reinsurance. Option D does not correctly describe the sharing arrangement in proportional reinsurance. Question 23. Under the principle of indemnity, how does reinsurance work to support the ceding insurer? A. It allows the ceding insurer to make a profit from the reinsurance contract. B. It provides a set amount of coverage for the ceding insurer regardless of losses incurred. C. It reimburses the ceding insurer for losses, restoring the financial position to what it would have been had the loss not occurred. D. It reduces the premium cost for the ceding insurer in the event of a loss. Answer. C. It reimburses the ceding insurer for losses, restoring the financial position to what it would have been had the loss not occurred. Explanation. The principle of indemnity ensures that reinsurance helps the ceding insurer recover financially from a loss, restoring them to the same position they were in before the loss. Option A is incorrect because reinsurance does not provide profit. Option B misrepresents indemnity, as reinsurance does not offer a fixed coverage amount unrelated to losses. Option D is also incorrect as it doesn't describe indemnity correctly. Question 24. What is a loss ratio in the context of reinsurance and why is it important? A. It is the percentage of reinsurance premiums collected by the reinsurer. B. It is the ratio of the reinsurer's expenses to its underwriting profits. C. Is the percentage of claims paid to premiums earned, indicating the profitability of the reinsurance contract. D. It is the ratio of the total number of claims to the number of policies issued. Answer. C is the percentage of claims paid to premiums earned, indicating the profitability of the reinsurance contract. Explanation. The loss ratio is the ratio of claims paid to premiums earned, and it is an important measure of the profitability of a reinsurance contract. A high loss ratio indicates that the reinsurer is paying out a significant portion of premiums in claims, potentially leading to less profitability. Option A is incorrect because it describes premiums, not claims. Option B refers to a different financial metric. Option D is not related to the loss ratio in reinsurance. Question 25. Which of the following is a common reason for an insurer to use excessive loss reinsurance instead of proportional reinsurance? A. The insurer wants to share a larger portion of the premiums with the reinsurer. B. The insurer is seeking protection against catastrophic losses that exceed a certain amount. C. The insurer desires a fixed payment regardless of the losses incurred. D. The insurer is primarily concerned with retaining a higher share of underwriting profits. Answer. B. The insurer is seeking protection against catastrophic losses that exceed a certain amount. Explanation. Excessive loss reinsurance is typically used to protect insurers from large catastrophic losses that exceed a predetermined threshold. It is not about sharing premiums in a proportionate way, but about limiting the insurer's exposure to large claims. Option A and D describe characteristics more associated with proportional reinsurance. Option C does not align with the purpose of excessive loss reinsurance. Question 26. What is the primary advantage of a reinsurer assuming the role of a facultative reinsurer for a particular risk? A. The reinsurer agrees to assume all risks of the ceding insurer automatically. B. The reinsurer is only responsible for the portion of risk they choose to accept on an individual basis. C. The reinsurer provides a guaranteed payout for all covered losses. D. The reinsurer covers a set amount of claims regardless of the risk involved. Answer. B. The reinsurer is only responsible for the portion of risk they choose to accept on an individual basis. Explanation. A facultative reinsurer evaluates each individual risk and decides whether to accept it and to what extent, providing more flexibility and control over the risks they take on. This differs from treaty reinsurance, where the reinsurer assumes all risks specified in the treaty. Option A is incorrect as facultative reinsurance is not automatic. Option C and D are incorrect because facultative reinsurance involves selective coverage rather than guaranteed payouts. Question 27. When reinsurers use the term aggregate excessive loss, what are they referring to? A. A reinsurance contract that covers a specific loss above a given amount for each risk. B. A contract where the reinsurer covers the total losses for the entire portfolio of risks once the aggregate threshold is exceeded. C. A reinsurance contract that covers only losses related to natural disasters. D. A form of reinsurance where the reinsurer provides fixed limits for individual losses regardless of their total. Answer: B. A contract where the reinsurer covers the total losses for the entire portfolio of risks once the aggregate threshold is exceeded. Explanation: aggregate excessive loss reinsurance is a type of reinsurance where the reinsurer covers losses once the total losses for a portfolio of risks exceed a predetermined threshold. This allows the reinsurer to protect the ceding insurer against the accumulation of multiple losses. Option A describes a different type of reinsurance, typically individual excessive loss. Option C is too specific and not correct. Option D describes a different structure of reinsurance. Question 20. Which of the following is the key benefit of catastrophe bonds, cat bonds, in the context of reinsurance? A. They allow the reinsurer to cover small, frequent losses without significant capital requirements. B. They provide a means for reinsurers to transfer the risk of large, catastrophic events to the capital markets. C. They ensure the reinsurer's profits will remain stable regardless of claims frequency. D. They guarantee the reinsurer will never face financial loss from natural disasters. Answer: B. They provide a means for reinsurers to transfer the risk of large, catastrophic events to the capital markets. Explanation: catastrophe bonds, cat bonds, allow insurers and reinsurers to transfer the risk of large, catastrophic events, such as natural disasters, to the capital markets. This provides additional funding and spreads the risk beyond traditional reinsurance. Option A describes a different type of risk management. Option C and D are incorrect, as cat bonds are not designed to guarantee stable profits or eliminate losses. Question 29. What is the primary purpose of claims-made reinsurance policies? A. To provide coverage for losses occurring during a specific period regardless of when the claim is made. B. To offer protection for claims made during a specific time period regardless of when the loss occurred. C. To cover only claims for which the ceding insurer has paid a premium. D. To allow reinsurers to choose which claims they wish to cover. Answer: B. To offer protection for claims made during a specific time period regardless of when the loss occurred. Explanation: claims-made reinsurance policies provide coverage for claims that are made during the policy period regardless of when the underlying loss occurred. This type of coverage is typically used for liabilities that may arise long after the loss event, such as professional liability. Option A describes an occurrence-based policy, not a claims-made policy. Option C is not accurate for claims-made reinsurance. Option D is incorrect, as claims-made policies are based on when the claim is filed, not on the reinsurer's discretion. Question 30. Which of the following best describes the term per occurrence in the context of excessive loss reinsurance? A. The reinsurer provides coverage for a single event or loss, regardless of the number of claims associated with it. B. The reinsurer provides coverage for each individual loss event separately with limits for each. C. The reinsurer covers all losses occurring within a policy year, regardless of the number of events. D. The reinsurer covers the maximum amount for each occurrence during a specified period. Answer: B. The reinsurer provides coverage for each individual loss event separately with limits for each. Explanation: per occurrence in excessive loss reinsurance means that the reinsurer provides coverage for each individual loss event separately, applying limits to each occurrence. This type of reinsurance focuses on the impact of each specific event or loss. Option A does not fully describe the limits per occurrence. Option C is not correct because it describes aggregate reinsurance, not per occurrence. Option D is incorrect as it does not specify the limits tied to individual occurrences.